All right, we're about 2 hours away from the closing of today's debt market at FMDQ OTC Securities Exchange. So let's get an insight into the intraday, how the market's been going on. Let's get a bit of analysis from Buki Bukola Adegbeshola, who is a fixed income trader at one of Nigeria's listed lender, Access Bank. Thank you very much. She's joining us via Skype from downtown Lagos. Talk to us. What comparisons would you be are you looking at between the yields at the opening today and where we are about 2-3 hours into today's session?
Opening the markets today, what we witnessed was a bullish trend on the treasury bills markets and the bonds markets as well. And that's generally because at the PMA auction yesterday, we saw the total subscription at 813 billion. However, the amount sold was just about 329 billion. So the unmet demand of 483 billion trickled into the market today, and that resulted in a downward trend in yields of about 45 basis points on the bond side and 30 basis points on the treasury bill side. However, at the moment, we've seen a bit of retracement as there's been a bit of profit taking, particularly on the bond side.
Yes. So what's your, as a trader, what's your striking? What strikes you in terms of today's market? Is it on the side of what tenor of the listed instruments on the FMDQ platform are investors really bullish on?
We're seeing a lot of interest around the 1-year bill, and that's because at the auction yesterday, the total subscription on the 1-year bill was about 600 billion, and only 222 billion was sold. So for treasury bill maturities around that tenor, there's been a bit of demand, and also on the short-term bonds as well, we've seen a bit of demand on that.
In terms of what has happened Thursday, are we expecting some form of treasury bills matured repayment to traders and investors by the central bank? Is this likely going to happen? And how much liquidity will this bring into the market?
For today, because there was a PMA yesterday, we have a zero net maturity, as what is maturing is what is being rolled over. For next week, there's no maturity coming into the market, and so we expect that this would influence liquidity in the sense that there wouldn't be an increase in liquidity, and this would definitely affect the markets as we expect yields to go up.
Okay. So do you think, so what's your short-term outlook on the market? You're trading, so you're seeing both the mid and the long-term end of the market. For any investor who wants to get into the market, where are the gains coming from?
For today, tomorrow, we see a lot of interest around the long end of the curve on the treasury bills. So that would be the 1-year bills. But on the bond side, we see a lot of interest on the short end, 2017 to 2019 bonds, and that's because of the liquidity in the market at the moment. However, in the next 1 to 2 weeks, because of the fact that there's not going to be any treasury bill maturity, and also because we're approaching the bond auction, we would expect that we'll see a bit of increase in yields across board as counterparties will take positions prior to the auction.
Okay, well, I guess we'll talk about the next debt management March auction. That's what you hinted about there. We'll see how the market paces out before that auction. Thank you very much for coming through to us from Access Bank, one of Nigeria's listed lender, fixed income trader, Bukola Adegbeshola, there talking to us about today's market. But let's get back to one of the big stories that you've seen in the news. Barclays, the UK's lender, says it's selling its investments 62.5% across Africa. But how much of this will result in job losses in some of the continents where the lender operates? This is from Barclays, Kenya. The authorities there says they have strategies in place to prevent Barclays UK's sell-off not impacting on Kenyans who work in Barclays, Kenya.
Barclays plc unveiled plans on Tuesday to simplify its UK and international operations to boost returns and cut costs, primarily by exiting its historic African business. The British lender said it will sell down its 62% stake in Barclays Africa Group to focus on two main sibling divisions, Barclays UK and Barclays Corporate and International, two of its strongest divisions, generating in excess of 10% return on equity. Barclays Africa Group was created by combining Absa Group and Barclays African operations. But the chief executive of Barclays Bank in Kenya, Jeremy Awori, said that the decision would not lead to job cuts in the East African country.
Consequently, the announcement does not impact the shareholding and ownership of Barclays Bank of Kenya and will not have any impact on the day-to-day running of our business or on our customers, clients and colleagues in Kenya.
News of the restructuring came as the bank reported a 2% fall in full year adjusted pre-tax profit. Awori moved to reassure the market that Barclays was working on a growth strategy in Kenya.
Barclays Bank of Kenya has best-in-class ratios on capital, liquidity and non-performing loans, which ensures we are able to deliver value to all our stakeholders. Our institution is founded on and governed by clear structures and sound business practices that have ensured our successful existence in this country for the last century. We remain committed to delivering our growth strategy, which is anchored on offering excellent service to our customers and value for our shareholders.
New Chief Executive of Barclays PLC, Jess Daly, said it will take 2 or 3 years to sell the bank's majority shareholding of Barclays Africa Group, and it would keep a minority part of the stake beyond that deadline. Analysts believe a lack of obvious suitors and dimmed economic growth prospects in Africa could make the sale difficult.
The Barclays Bank story just unfolding here from Kenya there. Barclays has about 100 years banking operations in Africa, employing thousands across the major markets in Southern and East Africa. That's about all for today. Thanks for watching Business Incorporated. I am Bosun Namafai. I'll see you next time.